Hi, I'm Joly. This is my channel, China's New Playbook. There is a tax time bomb sitting inside almost every China-focused private equity fund structured before 2026. It can take your effective tax rate from 10% to 25% retroactively. And most overseas investment committees do not even know it exists. But the managers who do know, they're already restructuring. Today, I'm going to show you exactly how sophisticated global LPs are moving capital into China, cleanly, compliantly, and with distribution pathways that actually work. We will dismantle the myth that China's capital controls make cross-border private equity structurally impossible. And I will give you the 4-step execution blueprint that top-tier managers are using right now. By the end of this report, you will know more about qualified foreign limited partner Qflp mechanics than 90% of the allocators currently sitting on the sidelines. But first, let's talk about why the conventional wisdom is costing you alpha. Here's the standard pitch you hear in Western boardrooms. Capital goes into China, but it never comes back out. Foreign LPs face an opaque labyrinth of forex restrictions, unpredictable repatriation timelines, and tax traps that erode returns. Now, I want you to pause for a second and ask yourself, when was the last time your investment committees actually updated this assessment? Because if you're still operating on pre-2026 assumptions, you're working with outdated intelligence. This was partially true 5 years ago. Today, it is an expensive misconception. The Qflp regime has undergone a structural transformation that most overseas investment committees have not yet priced in. What began in 2010 as a restrictive city-by-city pilot in Shanghai has expanded to over 50 pilot zones nationwide. And the new generation of policy innovations does not just tweak the old rules. It fundamentally rewrites the capital flow mechanics. But before I walk you through the architecture, let me be clear about what is at stake. The managers who understand this shift are deploying capital efficiently and building clean distribution pathways. The ones who do not are the ones who will deliver disappointing net DPI when the tax reality I mentioned at the top of this video arrives. Let's get into the mechanics. Let us strip this down to the mechanical level, because this is where the difference between a well-structured fund and a poorly structured one becomes millions of dollars in net returns. At its core, a Qflp structure is a licensed conduit. A foreign limited partner commits capital in foreign currency, typically US dollars or Hong Kong dollars, to an onshore Chinese fund vehicle that has been granted a Qflp pilot quota by the local financial regulator. That foreign currency is converted into RMB and deployed into domestic portfolio companies. Now, there are 3 structural modes, and this matters more than most people realize. Foreign managed foreign. Both GP and LP are offshore entities. Foreign managed domestic. A foreign GP raises from both offshore and onshore LPs. Domestic managed foreign. A domestic GP raises from foreign LPs. Each mode carries distinct regulatory and tax implications, and choosing the wrong one at fund formation can create structural inefficiencies that compound over the entire fund lifecycle. But here's the real breakthrough, and this is what your China Council should be briefing you on if they are current. Under the legacy Qflp regime, each fund receives a fixed quota, and every single cross-border capital movement required individual regulatory approval. Deploying capital into a new portfolio company? Weeks of bureaucratic processing. Returning distributions to offshore LPs? More weeks. It was a system designed for control, not efficiency. The new balance management model, first pioneered in Shenzhen, now replicated across Hanqing, Tianjin, Hunan, and 5 newly added cities, including Hefei, Changsha, Fuzhou, Xiamen, and Suzhou, fundamentally changes the game. Here is how. Under balance management, the pilot quota is granted to the fund management enterprise, not to individual funds. The manager can launch multiple funds under a single quota, dynamically allocate capital across them, and freely remit principal in and out within the registered quota ceiling, without transaction-by-transaction approval. Let me put that in plain terms. Capital can now move at the speed of investment opportunity, not the speed of bureaucracy. According to the State Administration of Foreign Exchange, SAFE, Guangdong branch, the Hanqing pilot zone achieved what regulators described as quota sharing plus dynamic allocation, allowing fund managers to move capital between funds and in real time based on investment opportunities, not bureaucratic calendars. The scale is no longer experimental. According to the People's Bank of China, PBOC, Shenzhen branch, by end of 2024, Shenzhen's Qflp pilot funding exceeded $7.7 billion. In Tianjin's Binhai new area, 27 Qflp funds have been established with over 8.6 billion RMB in foreign capital raised. And the investment scope has expanded far beyond simple unlisted equity. New pilot rules in Tianjin, Shenzhen, and Hanqing now permit Qflp funds to invest in private placements, mezzanine debt, distressed assets, and even function as funds of funds. This is no longer a narrow regulatory window. It is a full-spectrum cross-border private markets channel. Now, getting capital in is one thing. Getting distributions out is where most foreign LPs get burned. And that is exactly what we are going to cover next. Getting capital into China through a Qflp structure is now, in most pilot zones, a streamlined process. And I want to walk you through this quickly, because the engine mechanics are not where your execution risk lives. The exit is. But you need to understand the entry to appreciate what has changed. The foreign LP wires foreign currency into the Qflp fund's capital account at a designated custodian bank. Under the new balance management framework, the fund can convert that foreign currency to RMB without providing specific project-level documentation. If you have ever operated under the old regime, where each conversion required proof of a specific underlying investment, you understand how significant this is. According to the revised 2024 Shenzhen Qflp pilot measures, the joint review process for new Qflp applications has been compressed to within 10 working days. 10 working days for a cross-border private equity fund structure in China. But here's the development that I want every global allocator to pay attention to. Shenzhen's 2024 revisions explicitly support the interfacing of Hong Kong Limited Partnership Fund, LPF, structures with Qflp rules. This means Hong Kong domiciled fund vehicles can now serve as the offshore LP layer in a Qflp structure with materially reduced friction. Why does this matter? Because it means you can maintain your primary fund vehicle in familiar common law jurisdiction with established limited partnership governance. The governance framework your LPs already understand and your legal team already knows, while channeling capital onshore through a compliant licensed conduit. You are not navigating a wholly alien regulatory framework. You are extending a framework you already operate in. This Hong Kong LPF plus Qflp convergence is, in my view, the single most underappreciated structural development in cross-border China private equity, and it becomes even more critical when we get to the tax layer, which is where the time bomb I mentioned at the top of this video starts ticking. Speaking of which, let's get into distributions, tax, and permanent establishment risk, because this is the section where I need every allocator watching to pay close attention. This is where the conversation gets serious, because getting capital in is now relatively straightforward. Getting distribution out, cleanly, efficiently, and tax optimized is where the real execution risk lives. And it is where the separation between top quantile managers and everyone else becomes most visible. Let us walk through the two layers: distribution mechanics and tax retreatment. Layer 1. Distribution mechanics. When a portfolio company exits, whether through trade sale, IPO, or secondary, the Qflp fund receives RMB proceeds. To repatriate those proceeds to the offshore LP, the fund must go through the custodian bank's foreign exchange verification process. The bank reviews the partnership resolution, audited financial statements, and tax clearance documentation. Now, here's the operational friction point that sophisticated GPs plan for, and that most LPs do not even know exists. According to legal analysis from King & Wood Madison's, some custodian banks require that the fund be profitable at the overall fund level before permitting any distribution to LPs. Think about what that means. It creates a direct conflict with a standard PE industrial practice of deal-by-deal carry distribution, where a single successful exit should trigger carry calculations regardless of other unrealized positions in the fund. Top-tier managers address this by pre-negotiating distribution and repatriation protocols with their custodian bank during fund formation, before a single dollar has been committed. The ones who do not, they discover the problem at the worst possible moment, after a successful exit, when the LPs are expecting distributions, and the bank says no. Screenshot this next point, because it is a kind of detail that separates informed allocators from uninformed ones. The distribution protocol is not a legal afterthought. It is a structural feature of the fund that must be engineered at formation. Now, layer 2, the tax layer. And this is the development that every global LP must understand. Historically, Qflp investors enjoyed a favorable tax regime. Capital gains were subject to a 10% enterprise income tax and a withholding mechanism. Cash repatriation could proceed on the basis of a tax commitment letter, without requiring a complex tax filing as a precondition. It was clean, efficient, and predictable. That regime is closing. According to research published by Ken Wood Madison's, Chinese tax authorities are shifting towards a reinterpretation that Qflp funds constitute a permanent establishment or office or premise in China under both domestic tax law and tax treaty frameworks. If this interpretation is fully implemented, the applicable tax rate increases from 10% to 25%, and the calculation method shifts from deal-by-deal withholding to annual taxable income computation. Let me translate what that means in practice. A 15% point increase in your effective tax rate, applied to your entire fund's taxable income on an annual basis, potentially retroactively. This is not a theoretical risk. The report indicates that some local tax authorities have already proposed retrospective reassessment of Qflp tax filings for years prior to 2026. And this administrative shift is expected to be applied nationwide starting in 2026. Now you might be thinking, is there any defense against this? Yes, and this is where structural engineering becomes alpha. The permanent establishment analysis is highly dependent on the specific tax treaty between China and the LP's home jurisdiction. Under the China-Hong Kong double taxation arrangement, a properly structured Hong Kong LPF acting as the offshore LP may have significantly strong arguments against permanent establishment classification, particularly if the fund's management and control are demonstrably exercised outside of mainland China. The managers who are winning right now are those who, at fund formation, are building dual-layer SPV architectures. A Hong Kong holding entity leveraging the tax treaty, with an onshore Qflp fund underneath, that are designed to withstand not just today's tax interpretation, but more aggressive interpretations that are clearly on the horizon. This is not tax evasion. This is tax contingency engineering. And the difference between the two is exactly the difference between a manager you want in your portfolio and the one you do not. Now, let me put all of this together into a concrete execution blueprint. So how does a sophisticated global LP actually execute this? 4 steps. And I want you to evaluate your current China allocation or your planned one against this framework. Step 1. Jurisdictional selection. Not all Qflp pilot zones are created equal. Shenzhen offers the most mature ecosystem and Hong Kong LPF convergence. Shanghai maintains stricter capital requirements. Tianjin-Binhai offers the broadest investment scope, including distressed assets and FOF structures. Hengqin provides the most streamlined forex registration and is dedicated safe pilot. The choice of pilot city should be driven by your investment thesis, not by convenience. If your strategy involves distressed debt, Tianjin is your jurisdiction. If you need Hong Kong LPF interfacing, Shenzhen is a clear choice. If speed of forex registration is your priority, Hengqin wins. This is a strategic decision, not an administrative one. Step 2. Structure design. The optimal structure for most global LPs is a Hong Kong LPF as the offshore investor entity, investing into an onshore Qflp fund managed by a domestic GP. This maximizes tax treaty benefits, provides common law governance familiarity, and aligns with Shenzhen's explicit policy support for Hong Kong LPF Qflp interfacing. Step 3, and this is the step most managers skip. Distribution protocol pre-negotiation. Before fund formation, your legal counsel must negotiate with the custodian bank to establish clear distribution and repatriation procedures, particularly the deal-by-deal carry versus fund-level profitability tension I described earlier. If your GP cannot articulate their distribution protocol in detail during due diligence, that is a red flag. Step 4. Tax contingency structuring. Assume the 25% enterprise income tax scenario is coming. Structure your SPV layers and treaty positions to withstand that scenario, and model your returns at both 10% and 25% tax rates so you understand your true net DPI under stress. If your manager is only modeling the 10% scenario, you are looking at an optimistic projection, not a realistic one. 4 steps: jurisdictional selection, structure design, distribution protocol pre-negotiation, tax contingency structuring. That is the blueprint. Here is the strategic bottom line. The capital control argument against China PE allocation is no longer a valid reason to sit on the sidelines. The Qflp regime has evolved into a sophisticated multi-jurisdictional execution framework that, when properly engineered, allows global LPs to deploy capital efficiently and repatriate distributions with predictable tax treatment. But the window of the old 10% tax regime is closing. The managers who are building Qflp structures today with the assumption that favorable tax treatment will persist indefinitely are the ones who will deliver disappointing net DPI when the 25% reality arrives. The ones who are engineering for it today are the ones worth backing. Now we have covered the fund-level architecture. But the fund structure is just a container. What actually drives returns is what happens at a deal level. In our next report, we go beyond a fund structure and dive into actual deal level execution. How top-tier GPs are sourcing, diligencing, and closing specific transactions in the sectors we identified: industrial automation, high-precision robotics components, autonomous spatial intelligence, digital IP verticals, etc. What the term sheets look like, what evaluation dynamics actually are on the ground in 2026, and which specific deal structures are generating the strongest risk-adjusted returns. If you are an allocator trying to separate signal from noise in China's private markets, that is a report you would not want to miss. Before we get there, I want to hear from you. Has your investment committee updated its China capital control risk assessment in the last 12 months, or are you still operating on pre-2026 assumptions? Drop your institutional experience in the comments. I read and respond to every inquiry. And if this report gave you a framework you did not have before, the 4-step blueprint, the tax contingency model, the Hong Kong LPF convergence, then you already know that the next report will go even deeper. Hit subscribe. Let's figure out this new paradigm together. I'll see you in the next report.